The stock market can seem daunting for beginners, filled with complex jargon and fast-paced trading activity. However, understanding the fundamentals is essential for anyone interested in investing. This video aims to demystify the stock market, providing you with the knowledge needed to navigate it effectively. Before starting, don't forget to like and subscribe to our channel for more future updates. What is the stock market? The stock market is a collection of markets where stocks, shares of ownership in businesses, are bought and sold. These transactions can occur on exchanges like the New York Stock Exchange, NYSE, or through over-the-counter, OTC, platforms. The stock market serves as a platform for companies to raise capital by selling shares to investors. In return, investors gain ownership stakes in these companies, allowing them to benefit from the company's growth and profits. Why invest in the stock market? Investing in the stock market offers several advantages. Potential for growth. Historically, stocks have provided higher returns than other investment forms, such as bonds or savings accounts. Liquidity. Stocks are typically easy to buy and sell, providing investors with quick access to their funds. Diversification. The stock market offers a wide range of investment opportunities across various sectors and industries, allowing investors to spread their risk. How does the stock market work? The stock market operates on the principles of supply and demand. When demand for a stock exceeds supply, its price rises. Conversely, when supply exceeds demand, its price falls. Here are some critical components of how the stock market functions. Stock exchanges. These are platforms where stocks are traded. The most well-known exchanges include the NYSE and the NASDAQ. Each exchange has its own listing requirements and trading rules. Brokers. Investors cannot buy or sell stocks directly on exchanges. They must go through brokers, who act as intermediaries. Brokers can be full-service, offering personalized advice, or discount brokers, allowing for self-directed trading. Market orders versus limit orders. A market order buys or sells a stock at the current market price, while a limit order specifies the price at which the investor is willing to buy or sell. Indices. Stock market indices, like the S&P 500 or the Dow Jones Industrial Average, track the performance of a specific group of stocks. These indices provide a snapshot of market trends and overall performance. Types of stocks. Stocks can be categorized into various types, each with its own characteristics. Common stocks. Most investors buy common stocks, which represent ownership in a company and entitle shareholders to vote at shareholder meetings and receive dividends. Preferred stocks. These stocks give shareholders priority over common stockholders when it comes to dividends and asset liquidation. However, preferred stockholders typically do not have voting rights. Growth stocks. Companies that are expected to grow at an above-average rate compared to other companies. These stocks typically do not pay dividends, as profits are reinvested to fuel further growth. Value stocks. These stocks are considered undervalued relative to their intrinsic value. Investors believe that the market has overlooked these stocks, and they may be poised for significant appreciation. Dividend stocks. Stocks that provide regular dividend payments to shareholders. These are often sought after by income-focused investors. Investing strategies. There are several strategies investors use to approach the stock market. Buy and hold. This strategy involves purchasing stocks and holding them for an extended period, regardless of market fluctuations. Investors employing this strategy believe that, over time, the stock's value will increase. Day trading. Day traders buy and sell stocks within the same trading day, trying to capitalize on short-term price movements. This strategy requires significant market knowledge and can be risky. Swing trading. Swing traders hold stocks for several days or weeks to profit from expected price movements. They use technical analysis and chart patterns to guide their decisions. Value investing. This strategy involves identifying undervalued stocks with solid fundamentals and holding them until their price reflects their true value. Growth investing. Growth investors seek companies that exhibit strong earnings growth potential. They focus on stocks with high price-to-earnings ratios and reinvestment into the business. Risk management. Investing in the stock market comes with inherent risks. Understanding and managing these risks is crucial. Market risk. The risk that the overall market will decline, affecting the value of individual stocks. Volatility. Stock prices can fluctuate dramatically in short periods. While volatility can create opportunities for profits, it can also lead to significant losses. Liquidity risk. The risk of being unable to sell a stock quickly without affecting its price significantly. Sector risk. Specific sectors can experience downturns due to economic changes, regulatory changes, or technological advancements. To manage these risks, investors can diversify their portfolios, allocate assets wisely, and consider using stop-loss orders to limit potential losses. Getting started with investing. If you're ready to dive into the stock market, follow these steps. Educate yourself. Understand the basics of investing, market terminology, and different investment strategies. Books, online courses, and financial news are excellent resources. Set investment goals. Determine your financial objectives, risk tolerance, and investment horizon. Having clear goals will guide your investment decisions. Open a brokerage account. Choose a broker that aligns with your investing style. Look for low fees, user-friendly platforms, and robust research tools. Start small. As a beginner, consider starting with a small investment to learn the ropes before committing more significant amounts. Stay informed. Keep up with market trends, news, and economic indicators that may impact your investments. Understanding bonds and fixed income securities. While stocks can offer significant growth potential, bonds and fixed income securities play an essential role in a well-rounded investment strategy. Understanding these instruments can help you achieve a balanced portfolio and manage risk more effectively. What are bonds? Bonds are debt instruments that allow companies, municipalities, or governments to raise capital. When you purchase a bond, you essentially lend money to the issuer in exchange for periodic interest payments and the return of the bond's face value upon maturity. Bonds are often seen as safer investments compared to stocks, making them an appealing option for conservative investors. How bonds work. When you buy a bond, you receive periodic interest payments, known as coupon payments, typically made semi-annually. The interest rate, or coupon rate, is set when the bond is issued and remains fixed throughout the bond's life. Bonds have a maturity date, which is when the issuer repays the bond's face value to the bondholder. The time until maturity can range from a few months to several decades. Bonds can be traded in the secondary market, meaning their prices may fluctuate based on interest rates, credit ratings, and market conditions. Understanding fixed income securities. Fixed income securities refer to a broader category that includes bonds and other debt instruments. They provide investors with regular income, typically through fixed interest payments. The term, fixed income, signifies that investors can expect a predictable return on their investment, which can be appealing in volatile markets. Benefits of bonds and fixed income securities. Investing in bonds and fixed income securities offers several advantages. Stability. Bonds are generally considered safer investments compared to stocks, making them a stabilizing force in a diversified portfolio. Income generation. Fixed income securities provide regular income through interest payments, making them ideal for retirees or those seeking steady cash flow. Capital preservation. Bonds can help preserve capital during market downturns, as they tend to be less volatile than equities. Risks associated with bonds and fixed income securities. While bonds are generally safer than stocks, they are not without risks. Interest rate risk. As interest rates rise, the value of existing bonds typically falls. Investors need to be aware of this risk, especially if they plan to sell bonds before maturity. Credit risk. If the issuer defaults on its debt, bondholders may not receive their principal or interest payments. Researching the issuer's credit rating can help mitigate this risk. Liquidity risk. Some bonds may be challenging to sell in the secondary market, particularly if they are issued by smaller companies or municipalities. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.